Today we're talking to Arjun Devarora. Arjun is a calm voice in the storm when we're talking about fundraising and specifically the relationship between limited partners, the people who put money inside the VC general partners, the people who decide if they're going to make a bet on your startup, and the relationship they have with the startup founders, people like you and me who are out there thinking about raising capital. He's also an active angel investor, and he's worked on several unicorns.
I think all of this knowledge is incredibly valuable. You're entering into a very long-term relationship with these investors, so it's absolutely fair to ask all the questions.
So today, we're talking to Arjun Devarora about how to do startup sales. What do you think founders need to know about the relationship between VCs and where VCs get their capital?
This is something I've spent a lot of time, really digging into, and fortunate to have been in a few seats that have allowed me a peek behind the curtain. So I think the most important thing to understand at the highest level is that LPs are the ones who are funding the venture capitalists, and they have some degree of meaningful influence over the strategy that those GPs, use and tend to deploy in order to put money to work. And so one of the old adages is that the fund size is your strategy, and there's a lot of truth to that. So if you're running a multi-billion-dollar fund, you've kind of got to put checks to work that are of size, typically $25, $50 million to make it worth your while, or else you have to, cut up the fund into much smaller parts and pieces.
So a $100 million fund, what size checks are they writing?
$100 million fund would typically be a large seed fund. And so a fund of that size would usually write, $1.5 to maybe $2 million lead checks, sometimes a little more.
All right. So I got a fund, I go raise money for it. What's that like? Because you've done the fundraising process for the VC like several times now.
Yes. So it is incredibly challenging, particularly if you're a first-time fund or even a fund 1 through 3. And what you have to do is you have to really show that you have a differentiated view on the world and a very clear ability to see the best deals, pick the best deals, win the best deals, and then support those companies. So either if you pick a specific niche or vertical, you might, let's say you're a fintech investor like our buddy Shield at Better Tomorrow Ventures, they have a particular purview into the fintech ecosystem that is incredibly broad. Like they see everything that happens in fintech. So they've kind of won that initial sourcing game by being focused on a particular vertical. There's other folks who are great at picking. So they get to decide, of all the companies I get to see, here's the ones that I think are going to be winners. Now, you can be a great picker, but you may not ultimately win. And so the winning aspect comes down to, do you have a great brand? Do people trust you? Do they want you around the hoop to support you? And those are things to kind of think about in that regard. And then lastly, it's kind of supporting those founders. And, folks like, there's brands out there that have been very specific about saying, hey, we're going to spend all of our time and energy on supporting you on customer success or go to market or PR, like VSC PR. So these are some of the folks there that are kind of finding a niche on how to support the funds, and they can raise capital because they figured that out.
Yeah. So as a founder, what should I care about the LPs? Because really, it's like, can I get a VC who's got a great name, like let's say it is Shield at Better Tomorrow, right? So if I get a guy who's Twitter famous, who I like, who's got a unique perspective and has done some of the things I'm trying to do, what's the good and the bad of the LPs that back these guys?
So let's start with things that can go wrong. So I think in the sense that there are a bunch of LPs, let's say you take money from a first or second time fund, and you want their continued support, but they've chose to raise money from, let's call it non-institutional or non-long-term oriented capital. And let's say during a bull run, they just were able to raise money from high net worth individuals, people who made a lot of money on meme coins and a bunch of other things. Now, all of a sudden that fund has, real capital. They were able to deploy it. But the minute you might go through a challenging time or need a re-up or say, hey, my early investors are committed and they want to continue to support me, if they run out of cash because they don't have, let's call it serious investors, they may not be able to continue to be supportive to you. They may be too busy trying to figure out fundraising or keeping their firm alive. Now, even larger, more storied firms that have been around for a long time can go through generational transitions or can have issues where LPs are no longer as interested in funding them anymore. So there are certain funds out there where, the main GP who all the LPs back decided to leave. And now they've had a lot of issues internally that just means they have less time to be, present and supportive to you as a founder. So understanding who your GPs are, how it's structured, where they get their capital from, is it stable, is all really important to prevent those sort of issues. Now, let's talk about the good side too. So let's say you've got a great fund that's been around. Maybe they're on fund 4, fund 5. They have a ton of institutional capital. In some cases, even if they aren't doing well, they'll continue to invest if that happens. But now, those GPs don't have to really worry about fundraising. And better yet, if they have LPs that can even back your companies, back their companies and put money into your Series A round, your Series B, your Series C. Let's say, it's back to the good old days and you're raising a $100 million Series C. You may get a $50 million check from one of their LPs who's multiple billion-dollar entity that wants to put money into the winners. That's going to make your life a lot easier than having to run around and try and collect that additional $50 million. So having LPs who are stable or committed for multiple funds gives the GPs kind of a peace of mind and a psychological safety that allows them to be more present with their founders. And as you get close to an IPO, that's even more important because now you've got, really dialed in huge pools of capital that are really ready to kind of back up the truck to support you.
When you've got a friend who is going to raise let's say a seed or Series A round, what are the 3 best questions for them to ask during due diligence? What do they scribble down when they're having drinks with you that they're like, oh, I got to ask that. Because I know you give them your list.
So I think what you want to do is you want to find out, what is the kind of strength of the partnership, of the general partnership? Who are the partners? How do they work? How do they make decisions? That's really important. The second question I would ask is around, what is the makeup of your LP base? And you can ask that in a relatively broad, way. I don't think you need to get into the details of, which investor is investing, how much for how long, but just generally get a sense for, hey, we've got a really stable investor base. We've been fortunate to be able to, raise our funds relatively quickly. Or, they might say, hey, we've got a bunch of family offices, but they're very active. They invest in our companies, and we're moving towards institutionalizing our fund. Yeah, also a great answer. And I think you have to be comfortable with that. The third one, I think, is just understanding kind of the partner on your deals, longer term aspirations. Like, what are they interested in? How have they helped companies in the past? How do they want to continue to help companies, particularly if it ends up being a principal? Do they want to eventually start their own fund? Do they want to continue and grow through the ranks here? Do they feel like they're going to transfer laterally? Do they want to eventually go to operating again, but they're just doing a small stint in venture? Again, this is just part of building the relationship and understanding where their head's at. I think that's really important as well. I think it's helpful that it's a bidirectional conversation, right? I don't think that it should necessarily just be you're getting peppered with questions. You're entering into a very long-term relationship with these investors, so it's absolutely fair to ask all the questions of them. And I think, probably second, third meeting is a good time to kind of dig into some of these things.
What do you think the most misleading part of the fundraising process is?
I think when VCs will tend to continue to express interest but not move a process forward, I think is one of the biggest red flags. So it's like, oh yeah, I'm interested. Oh, share more data, but won't necessarily take another call or introduce you to other partners or, talk about terms or do something that is a material movement forward in the process, but rather kind of drag the process along either to preserve optionality or in a worst case, collect data for, some other reason. You just want to say, hey, let's call it. Are you guys in? Are you out? Like, I'm looking to get tight about my funnel and I'd like to have a clear sense from whether you're in or out and when you can make a decision by. And I think it's important to be really sharp on that. And this is some of the, general best practices from the sales world anyways, but it's kind of the nuance of how to apply it to a fundraising process.
I was thinking of that. I was thinking if I didn't know you were talking about fundraising, that would have sounded like
I think I'm talking about sales.
Great enterprise sales advice for founders, because I think if a lot of founders get kind of jerked around when they go to a big corporate and they get strung along because they don't say, tell me about the other startups my size that you've bought from, because instead they're like, please don't notice it's just 3 of us at the garage. But it could end up being a nightmare deal.
Absolutely. The other interesting thing is on the LP side, there's a similar thing here when you're raising capital from LPs. The only difference there is that the timelines are so elongated, that it ends up being a little different, and that there you do have to spend the time to really build the relationship over months, if not sometimes years. I think that's the caveat I would state, is that also understand the context, but at the same time, look for markers of progress. Those markers just may happen every 3 months instead of every 3 days.
Now that you know what you know about VCs and how they raise their money, would that
Yeah.
have changed
Yeah.
the 10 years previous when you were running Retargeter and building a seed Series A and starting to scale up?
Oh, yeah, absolutely. I think all of this knowledge is incredibly valuable because I think it also helps understand who are the VCs, who are the partners, who are the angel investors, investors that you want to have in your corner, and how are they oriented to what end, right? So if let's say you're building a company that you want to be more profitable, then and this market environment is a little bit different, but let's say you want to grow a little bit more slowly and you want to move towards profitability, then look for different type of fund entity. Look for someone that doesn't need to 10x the fund. You might find kind of a hybrid growth equity private venture capital sort of entity, somebody akin to an Insight Partners or Left Lane Capital that's kind of come out of that heritage of looking for a high quality 5x, not needing to go chase the 100x outcome because that's what they've pitched to LPs, right? They're the growth equity folks, or even certain VCs will say, look, I'm just going to churn out consistent 5x's, consistent 10x's. I'm not going to go out and swing for the fences and go invest in things like a Clubhouse. Not a knock on them, they're great, but if it wins, it's going to be absolutely massive and it'll be a game changer. But if it doesn't, you might throw away a couple $100 million.
It seems like there's every generation or vintage of startups, there's that story of who's going to be the big winner, and everybody knows the VCs are looking for that fund returner. And I think a lot of founders have taken that on to go, okay, I need to present myself as a fund returner. Like this day and age, you're not going to have anybody go to YC for that interview and not say, they're not going to say,
yes,
we got $1 billion market of this or that. They're going to say, we got an $800 billion US trucking market. And that's what we're going after.
Right.
And my problem with that is the founders, that's bad at sales advice. Like you should sell a very, very tiny market and figure it out. And then, build and grow depending on the strategy.
That point around finding alignment around the strategy that you're going after also means that you're going after a certain smart, VC who understands that, sure, it may be an $800 billion market, but tell me the, $500 million market $500 million market that you're going after first, and how you're going to win that, and how that opens up the gates to allow you to go after the bigger market. Putting my investor hat back on, talk to me about that, because I think that's much more interesting than just throwing a huge number out, which is helpful to know, but it's more about your strategic plan to get there, or what tests and iterations you're going to run in order to suss out what the right path may be. That tends to be a more realistic sense of how even some of the biggest and greatest companies, have been built. Classic Uber black car in San Francisco example is, a good one to start with.
What are the best resources and who are the best people for founders to follow and learn from during that seed and Series A stage?
The first round blog is just phenomenal. Shout out to Camille, who started that many, many years ago. And it's just an incredible repository of content. I think the early, Angel List, Angel Hacks, AngelList blog ecosystem has, tremendously helpful content. And then I think following, helpful VCs that just share, high quality information. So Charles Hudson at Precursor comes to mind. His Twitter and blog posts are just a very real take on what's going on, more from the investor perspective. And so I think that's super helpful.
When I was first trying to learn about funds and VCs, I saw that a Foundry had on their portfolio page, they have a bunch of funds that are listed. When I see that a VC who's done 2, 3, 5, 10 funds has made a bunch of bets on other seed funds, what do I make of that as a founder?
I think it's a way for particularly later stage funds, and many of this do. Foundation Capital has a program, Bain Capital Ventures has a program, like a specific program dedicated to investing in emerging fund managers. And then, of course, Sapphire Ventures is extremely famous for putting this in practice. These folks are trying to, predominantly in the case of the first two, Sapphire is a bit more kind of driven purely or mostly by the economic sense. And again, we'll ask them to clarify, but they have been very explicit, the Bain and the foundations, that they are looking for early stage funds that can help bring them high quality deal flow for their Series A and Series B. So they're looking to partner with funds that, have a particular alignment to their core thesis and therefore can, be their partners and kind of eyes and ears in the ecosystem. And so the benefit as a founder of taking capital from a fund that has that relationship or multiple of those relationships is that you do know you have a strong, warm introduction into those later stage funds. And that is valuable to know as a early stage founder, that you're going to have seed investors that are pretty plugged into the later stage capital ecosystem.
Okay, where do people find you, follow you, get more of your advice?
Yeah, so LinkedIn is where I've been posting a lot recently, and you can find me there, Arjun Dave Aurora, and Twitter as well, Arjun D Aurora on Twitter. So those are the two places. I've got a Substack as well for those who are interested.
Right on. Well, thanks so much for joining me. I appreciate it.